Every civilization is built on a story. Rome had its gods, monarchs had their divine right, and today our story is money. We are raised to believe in it more than anything else. That the numbers glowing on a phone screen, the balance in a bank account, the cards in our wallets, all represent something real, something solid. But what if that belief itself was the foundation of an illusion? What if our wealth, our savings, even our national economies, were built not on gold or labor, but on trust, a delicate, invisible thread that could snap at any moment? This isn't a conspiracy theory. It's the hidden architecture of the modern world, the quiet trick that sustains nations, fuels markets, and keeps billions of people believing that numbers are reality. It's called fractional banking. And once you understand it, you'll never look at money the same way again. The truth is unsettling. The money in your bank account doesn't really exist. That's not a metaphor, and it's not paranoia. If every person on Earth walked into their bank tomorrow morning and asked to withdraw their savings in cash, the global financial system would implode before the day ended. Vaults would empty, ATMs would shut down, and the illusion would evaporate in a single brutal afternoon. But this isn't a flaw, it's the design. Fractional banking isn't a bug in the system. It is the system, a centuries-old sleight of hand so deeply embedded into global finance that we've stopped questioning it. It's the invisible engine that drives debt, inflation, and the illusion of prosperity. To understand how this began, we have to go back to a world before online balances and mobile banking, back to the Middle Ages, when wealth was physical, heavy, and glittering. In medieval Europe, money meant metal. Gold and silver coins were real value, forged by kings, carried in pouches and guarded like treasure. The rich hoarded it in chests, while merchants risked their lives moving it from one city to another. But as trade expanded, carrying bags of gold became dangerous. Highwaymen prowled the roads, and every journey carried the risk of ruin. So a new idea emerged: trust. Wealthy traders began storing their coins with goldsmiths, craftsmen who already kept secure vaults for their own metals. The goldsmith would issue a receipt, a simple note stating that the bearer could reclaim the gold whenever they wished. Those pieces of paper began to circulate as money themselves. After all, why carry gold when you could carry a promise, one that everyone trusted just as much? And it was here, in this small act of convenience, that humanity crossed a threshold. The goldsmiths made a discovery: almost no one came to collect their gold at the same time. If they had 100 customers, maybe 1 or 2 would withdraw their coins in a week. The rest of the treasure sat in darkness, untouched. That's when the trick began. The goldsmiths realized they could issue more receipts than gold they actually had. If they held 1,000 coins, they could write notes for 2,000. Those extra notes could be lent out, earning interest on gold that didn't exist. As long as the people believed, the illusion held. Paper promises replaced metal wealth, and nobody noticed the difference. It was the birth of money from nothing. A quiet revolution disguised as bookkeeping. Once society accepted that a promise on paper could stand in for physical value, money became an idea, a story we all agreed to believe. Out of this idea, banks were born. They institutionalized the goldsmith's trick, turning private deceit into public policy. And soon, the most powerful institutions on earth were built not on gold or land, but on confidence. By the 17th century, governments themselves were addicted to the illusion. In 1694, the Bank of England was created, not as a public service, but as a solution to a royal problem. England's crown was drowning in war debt. The bank lent vast sums to the government, far beyond what it held in its vaults, in exchange for interest payments guaranteed by taxes. The monarchy got its wars, the bankers got perpetual profit, and the people, they paid for it with money that never existed in the first place. If that sounds familiar, it's because little has changed. The same pattern has echoed through the centuries. Governments borrow what doesn't exist, spend what they can't afford, and then tax future generations to keep the illusion alive. When America rose as a new economic power, it copied the same system. Early U.S. banks issued paper notes redeemable in gold, promising each note could be exchanged for real metal. But greed found the same opportunity. Bankers printed more notes than they could back, lending far beyond their reserves. Every so often the curtain fell, a bank run. Crowds of frightened depositors rushed to withdraw their savings, only to discover the vaults were empty. Panic spread like wildfire. Entire banks collapsed in a single afternoon. But instead of ending the system, governments enshrined it. They created central banks, powerful institutions that would guarantee public confidence and bail out private greed. The message to the world was simple: even if the money isn't there, we will make you believe it is. From that point on, money was no longer a substance, it was psychology. Its value came not from what it was, but from what people believed it to be. Now let's translate this into modern terms. You walk into a bank and deposit $100. You imagine that money sitting safely in your account, waiting for you. But in reality, the bank keeps only a fraction of it, maybe 10%. The rest is immediately lent out. Someone borrows it to buy a car. The seller deposits that same money in another bank, which keeps 10% and lends the rest again. This cycle repeats over and over, multiplying the original deposit across the entire financial system. By the time the chain ends, your $100 has become nearly $1,000 circulating in the economy. But here's the catch: only the first $10 ever existed as real cash. The rest is debt, promises waiting to be fulfilled. And that's the old system. In 2020, something extraordinary happened. The Federal Reserve quietly dropped the reserve requirement to 0%. That means banks no longer have to keep even a single dollar of your deposit in reserve. They can lend, invest, and expand money purely through digital entries. The multiplier isn't bound by physical cash anymore, it's pure confidence. Today, money exists because we believe it does. It's backed not by gold, not by silver, not even by paper, but by faith in a fragile promise that the system will still be standing tomorrow. Every time you check your balance, every time a government prints more currency, every time an economy grows, that belief is renewed. But belief is the thinnest thread of all. History has shown that when trust breaks, when people begin to question what their money really is, empires don't just fall. They vanish overnight. If banks no longer need reserves, what prevents them from creating infinite money? That single question reveals how far the modern financial world has drifted from anything ordinary people would recognize as logic. The short answer is, the leash no longer lies inside the vault, it's written in regulation, in frameworks designed by committees of central bankers, far removed from public life. This leash is called Basel, a global rulebook born out of financial crises. Refined by unelected technocrats who meet in Basel, Switzerland, at the Bank for International Settlements, a quiet institution often described as the central bank of central banks. They do not campaign, they do not stand for election, and yet the policies they create shape how every dollar, euro, and yen in the world is created. After the devastation of the 2008 crisis, these central bankers agreed that the old system had become too fragile, too reckless. And so, they wrote new rules meant to prevent another collapse. Under the Basel Accords, every bank must prove that it holds enough capital, its own real money, not borrowed funds, to absorb potential losses. The calculation is complex, but imagine this. If a bank wants to issue a $100 risky loan, it must hold roughly $8 of its own capital as protection. Those $8 act like a seatbelt, the last barrier between safety and bankruptcy. The riskier the loan, the thicker the seatbelt must be. In addition, banks must prove they hold enough liquid assets, cash or easily sellable securities like government bonds, to survive a sudden crisis without imploding. On paper, this sounds prudent, a way to ensure responsibility. But what few realize is that it fundamentally changed the logic of banking itself. In the old world, banks lent money that savers had deposited. Your savings account was the raw material of the economy. Today, that world is gone. Now, banks create loans first and the deposits appear later. When you sign for a mortgage, the bank doesn't pull cash from someone else's account or a dusty vault. It literally creates new money on the spot, typing digits into your balance that didn't exist the second before. That digital money springs to life the moment you agree to repay it. Only afterward does the bank calculate whether it holds enough capital to justify that risk, as defined by Basel's global standards. The result is astonishing. Over 90% of all the money in circulation today is not printed by any government. It is not central bank money. It is bank money created by private institutions the moment they issue credit. Every dollar in your checking account, every balance on your statement began its life as someone's debt. And this is where the system reveals its true nature. It is not built on wealth, but on confidence. As long as borrowers keep paying and banks keep lending, the illusion holds. The moment that chain is broken, when borrowers fail or banks panic, the system begins to collapse. This design produces three outcomes that no regulation, however sophisticated, can fully prevent. The first is inflation. When banks continuously multiply credit, they multiply money. The supply of currency expands faster than the goods it can buy, quietly eroding the value of every dollar in your pocket. Prices rise not merely from greed or scarcity, but because money itself becomes diluted, stretched thinner each year, like paint smeared across an ever wider canvas. The second is perpetual debt. Because every new dollar enters existence as a loan, there is always more debt in the system than there is money to repay it. The interest charged ensures the math can never balance. Someone somewhere must always default, refinance, or borrow anew. The system is designed to chase its own tail forever. The third is concentration of power. Banks collect interest on money they never truly had. Governments, in turn, use this power to fund wars, social programs, and bailouts without raising taxes, borrowing tomorrow's labor to pay for today's politics. Meanwhile, those who hold real assets, property, equities, commodities, grow richer as inflation lifts asset prices higher. The middle class, reliant on wages and savings, watches their purchasing power dissolve like frost under the sun. History has warned us repeatedly, but we rarely listen. In the late 1920s, banks lent recklessly, far beyond their reserves, fueling a stock market frenzy that seemed unstoppable, until the moment panic struck. In October 1929, millions rushed to withdraw their savings. The money simply wasn't there. By the end of the Great Depression, over 9,000 banks had failed, and the illusion of prosperity lay in ruins. 80 years later, the same pattern returned under a new disguise. In 2008, banks again created mountains of leverage, this time through mortgage-backed securities, complex financial products built on the same ancient principle: more promises than reality. When homeowners began to default, the pyramid of paper collapsed. The global economy froze. Once again, governments and central banks intervened, printing trillions, slashing rates, and backstopping losses. They didn't end the illusion, they institutionalized it. The message to the world was unmistakable: we will save the system at any cost, because without it, the modern world stops. Today, the fingerprints of Basel stretch across every economy on Earth. In the United States, reserve requirements have vanished. In the United Kingdom, Canada, Australia, and much of Europe, they're symbolic, mere technicalities. Every major economy now relies on Basel's capital standards as the backbone of monetary control. Yet in emerging nations, China, India, Brazil, and others, echoes of the old world remain. Their central banks still enforce double-digit reserve ratios to tame lending and inflation. But even there, Basel's framework hovers above it all, defining how much risk banks can take, and how much illusion is allowed to exist. It doesn't matter if you live in New York, London, or Mumbai, the leash on money creation no longer sits inside your country's borders. It rests in the hands of global regulators in Basel, Switzerland, a city few people could find on a map, yet one that quietly writes the limits of our financial reality. And here lies the most disturbing truth of all: the system cannot survive without your debt. If every household in the world paid off its loans tomorrow, the money supply itself would collapse. Banks would have nothing to lend, interest would stop flowing, and the economy would freeze. The illusion would shatter overnight. Your willingness to borrow, your mortgage, your credit card, your student loan, isn't a side effect of the system. It is the system. You are both its fuel and its collateral. From the goldsmiths of medieval Europe to the skyscrapers of Wall Street, the same alchemy endures: promises multiplied beyond the limits of reality. And when those promises break, when confidence fades, the entire machine trembles. The bank runs of the 19th century. The Great Depression of the 20th. The housing collapse of the 21st. Different centuries, same story. Every time, the public loses faith, and every time, the response is identical. Double down, patch the illusion, print more money, promise it will be different. But the fundamentals never change. The modern economy doesn't rest on productivity, innovation, or even real savings. It rests on one fragile belief: that tomorrow will always be able to pay for today. So what can we take from all this? First, that money is not wealth. True wealth isn't measured in digits on a screen. It's measured in what endures when those digits vanish: land, skills, resources, independence, the capacity to produce rather than consume. Second, debt is not neutral. It's the bloodstream of a system tilted toward lenders and governments, where interest flows upward and inflation quietly taxes everyone below. Third, inflation is not a mistake. It's a feature, a silent mechanism that forces every worker, every saver, every business owner to run faster just to remain in place. This isn't a call for panic, it's a call for awareness. Because understanding the illusion is the first step toward escaping it. If every dollar in circulation was born as someone else's debt, then true freedom begins not with more savings, but with independence from the machine itself. When you build assets that live outside the system, tangible wealth, creative skills, productive land, enduring knowledge, you step beyond the reach of the illusion. And that's the ultimate irony. The same trick that began in a goldsmith's vault now rules the digital world. The faces have changed, the tools have evolved, but the principle remains unchanged, promises multiplied faster than reality can sustain. History doesn't repeat itself, it compounds like interest. And every time belief begins to fade, the same question returns. How long can a civilization built on borrowed faith survive?